You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Friday. So, Retirement Friday. Today, we are following up on last week about pre-retirement investment strategies. Today, we're going to talk about how to build a cash reserve. Cash reserve, super important for, I would say, two reasons. Like the first one, you feel a lot better when you have like some cash on the side, especially when you go into retirement, you lose the ability to generate money because you stop working, and therefore you count on your portfolio and other sources of income to generate your retirement pension. If you are fully invested, that's a problem. In a sense where if the market drops by 15% and you do not have cash and you have to sell some of your assets to build your retirement paycheck, well, that could hurt. Like that could hurt a lot, actually, right? All the graphs that you see about the sequence of withdrawals. So the sequence of withdrawals is, imagine that you retired today and today is the beginning of a market crash. Well, you will likely have like 10 years less of income going forward as opposed to someone who retired like 5 years ago in the middle of a bull market and then started their retirement as the portfolio keeps on growing and generating income from the dividend on top of that. Well, it's a much better place. The problem is you don't know if you're retired this year if the market is going to drop now or in the next 3 years. And if it drops in 3 years, you're all good. You started already to build your portfolio and everything is fine. But if you retire today and you're not prepared, that's a big problem. So that's the point of having a cash reserve, is on top of like feeling good about it, well, you can avoid all those market correction, market crashes, and actually just count on this liquidity to finance your retirement while you're waiting to see how long it's going to take for your portfolio to recover. So that is probably the most important question here, is how big of a cash reserve should it be? And that's a very tough question to answer, because the bigger your cash reserve is, the lower your expected returns will be. I mean, in an ideal world, if you could live on like 2% interest on a cash reserve, well, then you put 100% of your portfolio there. You don't have to think about the market anymore. You don't have to worry about anything. So you can go on cruises, travel the world, spend time with your families and friends, and do everything that is on your bucket list. But that would require a lot of money, right? So for most of us, we will have to stay invested in an investment strategy that is focused on generating a higher total return than money market funds. And right now, yes, money market funds, you're going to tell me, but Mike, they're pretty generous. They're above 4%. I mean, if the Bank of Canada keeps on cutting rates, it's not going to stay there. And it's going to likely going back to maybe like 3%-ish, maybe 2%-ish. If you have like cash reserve that is not tax sheltered, it's going to also be fully taxable. So a good chunk of that interest will actually be gone to the government. So it's very tough. So you first need a good financial projections to know how far you can go there. But here's a way to look at it. I like to have a cash reserve that is the equivalent of a 3 years gap. What's a 3 years gap? So imagine that you have $1 million, generates 3% return. So you get $30,000 in dividend per year, but you need 50. So your gap is $50,000 minus 30. That's equal 20,000. And I'm not talking about like other source of pension. Let's just say that at the end of the day, you need to withdraw $50,000 from your $1 million portfolio, but it only generates 30. So the gap is $20,000. So every year, it means that you will have to sell assets from this portfolio in the amount of 20K to bridge that gap. So what happens if there's a market correction on a specific year? You don't want to be selling when your assets are down 10, 15, 20, 25%. That would suck. So to avoid that, you build that cash reserve that is the equivalent of that gap for 3 years. So in that example, that would be $20,000 times 3, 60,000. Why 3 years? Well, that's the question, right? Why not 10? 3 years is enough to cover most of bear markets on average. And when I talk about a bear market, I'm talking about a stock market where from its peak level to its lowest point, it's at least down 20%. So we had one in 22, we had one in 2020, we had one in 2018. Of course, some of them were just like down, up and down within like minutes, like in COVID in 2020, but in 22 took about 18 months to recover, roughly, depending on how you were invested. And of course, it has to be well diversified, because if you were invested like 100% of your assets in a specific sector, and this sector is at the middle of the crisis, it's going to take more than 18 to 24 months to recover. But on average, a bear market will take 18 to 24 months to recover. The great example that we had, like 2018, 2020, and 2022, that's pretty much what happened there. Now, we do have crashes that take longer, right? Such as the tech bubble in 2000 and the financial crisis of 2008. Those took 4 to 5 years to recover. So that's why I think 3 years is a good compromise between having most of your money invested in the stock market, producing higher expected returns, while you have enough cash reserve to wait for the bear market to recover before selling any assets. If you're stuck in a major correction, that takes more than 3 years, you'll have to sell assets at one point that are not fully recovered, but at least you will be on the upside. So it's going to be less, like the impact on your plan will be a little bit smaller. So now, how did you build that cash reserve? Well, actually, I would start by using my selling rules. We've discussed this week on Wednesday on episode on the Moose Markets, where I explain to sell in only 3 situations. So when the investment thesis is not backed by financial metrics, when there's a dividend cut, and for diversification purposes. So that would be the first way how I would start building cash before I retire. I would clean up my portfolio using those selling rules. Then I would probably look at smaller positions, like positions under 1%. They don't bring much to my portfolio in terms of diversification, because even if they double, I mean, going from like 0.24 to 0.48 of my portfolio, not going to make a big difference. So I could trim into those smaller positions, get rid of those as well. Part of the cleanup. I would also take away the speculative plays or the educated guesses, like all the gambles, all the things that I'm not 100% sure in my portfolio. I would start to get rid of those as well to try to build a safer portfolio, like accepting that maybe I'm not going to generate as much returns as while I was in the accumulation phase, but that's okay. I want to increase my comfort and like dropping the stress about retirement, not increasing it. I would stop dripping, of course, because all that dividend that could be deposited in the account could build the cash reserve by itself. So the idea here is to have like specific rules like this. The clearer, the better. It's easier to take action, so you can get rid of like a lot of like companies that are meh. Companies that don't have strong investment thesis or a strong dividend triangle. Clean up the smaller positions in your portfolio, and once it's clean, well, technically you should have enough for the 3 years of gap. And if everything is perfect, well diversified, and you're a-okay on everything in your portfolio, well, then you can just trim a little bit of all your positions. It's going to be more costly in terms of transaction fees, so depending on where you trade, it could hurt, but could be a good way if you don't see what you could sell and everything is great, well, then you just trim everything and then you're going to be fine. And that you will have enough cash reserve to include in your projection to be fully protected and be more confident to start your retirement. If you are in this position right now, if you have questions about your retirement, if you are a young retiree or about to retire, we have started a retirement community that is called Retirement Loop with almost 500 members. You can get on the wait list. Right now, the doors are closed, but whenever we reopen, you can be the first one to know. The best way to do that is to sign up for a retirement newsletter at moosemarkets.com/retirement. So you're going to be the first one to know when we reopen Retirement Loop. And on top of that, we're going to provide you with some insight about how you can build your retirement plan, how you can increase and improve your retirement pension, how you can create your income, and all of those things. So so moosemarkets.com/retirement, pretty easy, right? You go there, you put up your name, and then you're going to be subscribed to our wait list. All right, Moose, that's enough for today. Enjoy your weekend, and we're coming back on Monday for more investing talk. In the meantime, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.